Hi everyone. Today our subject is option selling or option buying better. I hope you know already what is option selling and buying. Those who have no idea about buying and selling options, please refer to some videos or even the videos that I have posted earlier. A general idea about options. Please watch those videos and then come to this. We will be discussing only selling is better or buying is better. Option selling is also good, option buying is also good, but as a retail investor, what we have to choose? Which is better for a normal retail investor? There are people making lakhs of money on daily basis. You might have seen many YouTube videos. There are many traders making money on option buying. Those who have like 15-20 years experience and they know better than anybody, where to enter, how to enter, and when to enter, to a trade and exit. And they're using some techniques, some analysis, and they take huge risk. When they are in option buy trade, they are taking huge risk and they are ready to lose 3 lakhs or 5 lakhs even a day to make 4 to 5 lakhs profit. So if you don't have that courage and you don't have that much capital, to lose, you would not be able to enter to such trades and in panic. Later you'll be in panic situation. So here we are discussing, for those who are retail traders and those who don't have that much capital to risk and to invest. Options are always risky. So when you are into option trading, you must control your trades. You must control your emotions and you must maintain your capital, steady. Otherwise, what happens? Even an expiry day can eat all your capital. So we'll be discussing, which is better, buying or selling. Let's go to the video. This is same like if you have not seen those videos on general ideas, then watch it and then come to this video. Most of the option sellers are professional traders. If you look at the market, the big fund teams or FIs, they are sellers. If you go to an option chain to analyze open interest, what is there? It is all sellers data. You don't find any buyers data there. Because market trust only sellers. Why? Because they need a huge capital. So they analyze well before investing on options. So we use their data, as option data. If call option, if the sellers, if they are more in call side, we expect the market to go down, or the market, we assume that the market will not go above that strike price. If they sell put options, it means we expect the market to go above a particular level. So most of the professional, not most, I think all the professional traders are option sellers. So we'll be discussing some important points here, and I hope that after watching this video you will be able to decide either to sell option or buy option or to combine these two in a strategy. So let's go point by point. Probability of profit. In other words, it is risk reward ratio. The seller receives premium upfront and retains it until it expires worthless. This is what is giving them profit for an option seller. The longer they hold, better for them. In case if the market is moving sideways or in their direction. So in these two conditions, either sideways or in their direction, sellers are making profit. So probability of profit is always in favor of an option seller. Option buyer is not at all in this picture. If you have seen, some studies done by, especially I think it's Zerodha, one of the leading brokers in India, they have clearly analyzed and published the result that 99% of option traders, I'm not saying there are, I think they say 90%, but if you go in detail, you will find it that 99% of the option traders are losing their money, and it is mainly buying options. And buyers have only one choice. Market should go in their direction as soon as they enter to a trade. When you buy an option, you expect that premium to go up. It means the underlying asset should go in your direction. Either put option you buy, that means you are expecting market to go down, but the market should go in your direction as soon as you enter into the trade. Otherwise, what happens? The premium value will start depreciating immediately. Once the underlying asset goes against their view, it is almost difficult to hold their positions even. For example, you buy a call option and the market goes down, you will not be able to hold it because in seconds, the premium will be depreciated, and holding a position time decay will also affect your premium, and it is almost impossible for a buyer. You have to book your loss and come out immediately, and it is the most riskiest part of buying options. 99% of buyers lose their money here. So probability of profit is always with an option seller. Now time decay. Time decay, I have already made a video on time decay and discussed detail. So here options are a wasting asset. Already I have clearly mentioned that when you buy an option, it starts depreciating immediately. Otherwise, the underlying asset should go up drastically. If it goes up, then of course the premium also will be increasing. But that doesn't happen most of the time. 95% of the time, market either sideways or it is always sideways. So this is supporting an option seller. So this time decay is helping option sellers to make profit. So option writers or sellers benefit from this time decay. Buyers do not get it. Instead, they are losing money on it. So time decay is working always against an option buyer when it is always in favor of an option seller. Now we'll look into consistent income, generating consistent income. Selling options giving a consistent income, making it suitable for someone looking for regular income. This has been studied and analyzed. And one of the very important points, market bias, neutral market bias. A hard part of option trading is to predict where the market would go next. Option buyers need only one specific direction in the market, which is not possible or almost impossible. As I said, when you buy an option, you need the market to go in your direction, and it should start immediately as soon as you buy an option. And that doesn't happen. It is a very risky trade, and you can't expect the market to go in your direction as soon as you buy an option. But when it comes to selling an option, selling options can be neutral market strategy. They have the sellers have the luxury of making profit even if nothing happens in the market is moving sideways only, or even it moves in their direction. They just have to pick a strike price where they think the market will not get into at expiration. For example, if you're selling an option 20,000, Nifty, you market is now trading at 19,300, 400 level. So you know already that market will not reach 20,000. So you sell a call option. You sell a call option strike price at 19,900 or 20,000, even if the premium is 3 rupees. But by next expiry, you will be getting that 3 rupees per unit. Why? Because the market is not going to reach 20,000, you know already. But we just need to wait like 5 days, 3 days, 4 days time, and the premium will be depreciating day by day, and finally that becomes worthless, it becomes zero. Then you will be benefiting from that option selling. Lower volatility exposure. So selling options can reduce a trader's exposure to market volatility compared to option buyers. Option sellers can benefit from time decay and option expiring worthless rather than affected by sudden swings that happens always in the market. See here, volatility of the market. Market is always volatile. That moves sometimes, most of the time in a channel, in a range, up and down, up and down. It goes to the resistance levels and comes to the support levels, again going up to the resistance, support coming down. So this is what is happening always. Even if it goes up, it never goes up in a straight line. There is down up movements. So volatility exposure, for example, when you buy an option, you will not be able to hold it for even 10-15 minutes. When you see the market is going up and when it comes down to a point, that will force you to square off your position. This is what is normally risk reward system that works in that way. So you buy an option 100 rupees per unit, it reaches 115, so you can see like 5,000 or even 8,000 rupees profit. Then the next swing, when it comes to the support level, this 5,000 will become zero. Then again it comes to 2,000, 3,000 levels. So holding a position, with market volatility, it is very difficult if you are a naked option buyer. But selling options, that is completely against option buy. So selling options can reduce a trader's exposure to market volatility. And as long as they hold their position, the time decay will support and will help them to make profit. Range bound markets. Selling options can be profitable in range bound markets. This is what we just discussed, where the markets stay in a particular range or channel. If you analyze the chart of Nifty or Bank Nifty, you can see most of the time that trades in a channel. Nifty, when it went to 19,900, it was trading between 19,800 to 900 range. And Nifty came down to 800 levels, it was trading between 600 and 800 levels. So market is moving only between these 2 points. So if you are an option seller, then you can easily make money. You can sell call option and put option into strike prices, and in 2-3 days the time decay will support and you will be making profit on it. So sellers can execute a suitable strategy in these conditions and maximize premium capture. Now, less price sensitivity. As an option seller, you don't have to be as price sensitive like an option buyer. Sellers can benefit from a range of prices and not just a specific price. So you have choice, you can sell different strike prices. You're a seller, you can buy you can sell call options, you can sell put options at different strike prices and do some adjustments, and when a trade goes against your direction, you can square off it and do the adjustment. So your price sensitivity is not affecting you like an option buyer. An option sellers have flexible strategies to manage their strike prices and profit. They can use stops and hedging, and these two also supporting to reduce the risk involved. Stop means like square off your positions. When you have 2 3 strike prices, if something is working against you, you can stop and square off that particular leg, from your strategy, and then otherwise you can create a new strategy to hedge your positions. So your risk involved, in a trade is less compared to an option buyer. Now you decide, whether you agree or you come to a conclusion that a risk of loss is always present when you are a buyer or seller, and this must be controlled and action should be taken in time. Selling options, selling option has a risk of unlimited loss. But what does it mean? It doesn't mean that you're going to lose your capital, all your capital. You have an option, either you can square off your position if it works against you, or you can do adjustments. But if you keep a position, you sell an option and you keep a position without doing anything, without doing any adjustments, or without reacting to the market volatility, then of course there is a risk of unlimited loss. But when you buy an option, there is a risk that 100% of your capital can go away, unless and until you square off your position, accordingly. If you analyze well, you could notice that professional traders prefer selling an option rather than buying. But why they do that? Definitely, they would not choose option selling if they lose their money. So, professional traders and big traders, fund team, HNA clients, and all those, they prefer selling options rather than buying. Retail traders should start learning from these big clients, big fund teams. Why they are selling? Because they benefit from option selling. So, as a retail trader, what we should do? We should learn from these big fund managers or fund teams or FIS. Big FIS teams, they create huge positions in the market, and we always analyze open interest based on their plan. So we have to learn out of their trading strategy. Keep a bigger part of your trading time in selling options and use buy only for hedging your positions. When we say option selling is better, it doesn't mean that we should not touch option buy. Of course, we have to combine these two, but most of the time sell your positions, and what we have to do, we have to use buy only for hedging your positions, and that can be temporary on daily basis. So in case your market goes against your direction while selling an option, buy an option always will support you. You can also hedge your put position with selling a call. At the same time, when you create a strategy, buy an option also will help you to hedge your positions. Hope this video is clear, and decide whether to sell or buy or combine these two in a strategy, but always keep bigger part of your trading time in selling options. That's it for today. Thank you for watching. Wishing you all success.